Welcome to Money and Me, where we look at the financial life stories of successful people. My guest this week has gone from being an apprentice joiner in Dundee to one of the biggest landlords in Scotland. His name is Graeme Carling. Graeme, welcome to Money and Me.
Thank you.
Now, obviously we're going to talk about what you're doing in the property world today, but first I want to just kind of roll back the years a bit and find out what life was like in the early days, what sort of family environment you were brought up in, and whether things like money or property or investing were even mentioned.
Yes, well, back in Dundee in the 70s and 80s, money and investing was absolutely not mentioned or part of anything that we spoke about in my family. The only sort of money, the time that money was talked about was we didn't have any, with the lack of money and how we were financially struggling, right through those days. Yeah, so no, certainly it's changed days, but no, we didn't. It was really a taboo subject, if you like. It was, we were as kids certainly growing up. The only money, the money that was talked about was the lack of money, rather than certainly not for investing or saving or anything like that.
So what were your kind of early career plans? You started out as an apprentice joiner.
Yeah.
How did things develop from there?
Well, apprentice joiner because I didn't do particularly well at school, and in that, all my friends were leaving school to become an apprentice and get a trade and work in the construction industry. And it was just something that you just done, rather than any plan or clear path. It was just something that you done. You finish school at a certain time, you can get an apprenticeship or a YTS at that time. So there was a number of these youth training schemes going on. And I remember I was fortunate enough to get a YTS placement with one of the construction firms, one of the largest construction firms in our area at the time, and get the grand sum of £29.50 a week.
Wow.
And become an apprentice joiner.
Okay, so how long did you stay in that profession before moving on?
Not long. My dad was promoted and we moved. I was only there a few months. I was doing two jobs. I was delivering milk in the morning, so I was up at 4 delivering milk, getting dropped off, doing my day job, if you like, getting home tired, then going to sleep at night. So I'd done that for probably 5 or 6 months. Then we moved to Kent. My dad got promotion and we moved down south to Kent. When we arrived there, I couldn't get if you like, another apprenticeship at the time. So I managed to get a job in a transport office, and and that was that. So completely different. Yeah. But actually, I was on more money, so I quite enjoyed it.
And I think it was in Kent that you got your first kind of experience of property. What attracted you to become a landlord?
Well, what happened was we were there for a few years working there, and I actually bought my mum and dad's house when they relocated back to Scotland. So my boss at the time had been on at me for probably 18 months, 2 years to get on the property ladder as soon as possible. And I didn't really know much about it, but it sounded good. So when my mum and dad moved back, they needed kind of a quick sale. They'd done me a good deal on the property, I thought at the time. And so I bought that from them, and they moved back to Scotland, and I let it out because I'd moved back to Scotland also.
Okay, but from what I understand, it wasn't the greatest experience of being a landlord.
No, it wasn't at all. It was, for the first 3 or 4 months, it was fine. Then the tenants started usual, missing payments and late payments, missing payments. Then it ended up just a disaster. I think we had to go through a recovery process. The property was trashed in the end up, and at that time, I only had one property, so that was 100% of my portfolio was in distress. Oh, yeah. So it quickly became I sold it, I recouped my losses. I didn't make much, but so it was more of it definitely put me off for a number of years anyway.
So having had that really rough initial experience, what were the circumstances that eventually brought you back into the property market?
Well, timing was one of the things, and the fact that I had learnt more. I'd went and really understood money and debt and financing and leverage and all of that stuff. But that wasn't until later, mid 2000s, sort of big gap there from when I first bought my first property back in the 90s. So I'd started a number of businesses myself. I'd always had this desire to run my own business, even though I was good as an employee, I really always had this, within me. I wanted to run my own business, my own companies. So after my third failed business, back in, I think it was 2002, I caught a thing on the TV. It was the tail end of an Oprah Winfrey show where she was interviewing Robert Kiyosaki. And they mentioned the book Rich Dad, Poor Dad. Now, at that time, I was kind of licking my wounds. I had no money. I'd lost all my money in my previous business ventures. My confidence was low. My ego was dented. All that stuff. And but I went and bought the book, and Rich Dad, Poor Dad in 2002, and I read sort of every other book since that he'd published since Rich Dad, Poor Dad. And I just got right into that. At the time, I was a full-time employee, doing well, but I always had this. So it took me a while to recover from that. So, it's one of these things whereby I can act quicker now, but it did take me a while at that time. Yes.
But I tell you, I think to me that the genius of Robert Kiyosaki is that he took relatively mundane topics about personal finance and double entry bookkeeping and turned them into this fascinating story that gets everyone hooked. Yeah. And you obviously were hooked. I think you started going to some of his events.
I did, yeah. We went. We didn't know actually there was a sort of rich dad education events in the UK. I'd been that into Robert Kiyosaki and the US sort of teachings that he was doing, and so we just started going. I said my wife and I started going across to Scottsdale, Arizona, when he was doing the sort of bigger seminars, and that really helped us and boosted us. And it's more context driven than content. So it's more not the information, it's how you think, and you look at deals and investment and all that stuff. And I really liked that. I thoroughly enjoyed it, and it was a real light bulb moment for me personally.
Because I think what happened, as I understand it, is you came away from that, you took huge action, then you went back to another event where you told them about it, and suddenly you become great mates.
Yes. Yeah, it did. I mean, it didn't happen sort of overnight. We were going sort of once or twice a year over to Scottsdale, Arizona, and so it was a few events, but we were there continuously. We were dedicated to it. We were committed to it, and it was expensive to go there, and at the time, and going twice a year, and having to be there. But it was just felt so right for us to go to these things. And I think just over the course of time of being there and being in the company of Robert and Kim Kiyosaki and some of the other Rich Dad advisors, we just became friendly and became friends, and we were invited to private events. And so it was a over sort of 3, 4, 5 year period of going across to the US, and also other seminars that they were holding throughout the world. So we went to Moscow, we then went to Prague, London here, Excel. So where we've assisted them in some of the seminars. Yeah.
I think the key thing as well, though, is you weren't just a seminar junkie, which a lot of people do become. You were taking action. Yeah, so I think but fairly quickly you were able to say to him that you'd got 100 properties under your belt.
Yeah, and it was absolutely right. I mean, these, every time we went to a seminar, we needed to make sure that we'd achieved significantly greater before we went back to the next seminar. So it was a real sort of energy boost for us going to these things, and we always learned something. But and go over the years, I would probably say 75-80% were just seminar junkies, like you say. They were just going for the social, not us.
But I think it's interesting because what you said was it's changed the way you think.
Yes.
As opposed to lots and lots of mechanics and nuts and bolts. Yes. It's all about what's going on here, isn't it? And that's where you just sort of decided that I've got to think on this bigger scale. Yes. And suddenly you end up as one of the biggest landlords in Scotland because of that. Yeah. So
it was so different. The message was so different to what we're saying there, to what I grew up with in terms of money and get out of debt. Debt's bad. wealthy people are greedy and all that. It was completely different message, and it resonated with me. You know, I believed it, you know, and I still do. You know, so it was to an environment I was brought up in. It was so different.
That's right.
That I just
so it's making money work for you rather than working for money, being one of the core messages.
Yes.
Clearly.
Yeah.
Okay. So. Obviously, it's great that you take action and you're building that portfolio, but one of the challenges with property, especially I think with your strategy of holding it for rental income, is you do need a lot of capital. So, so how have you found, you know, raising the capital to go from like 0 to 100 plus properties?
Yeah. Well, I think if you go back, the rich dad model, and it's sort of ingrained in us now, is very much about cash flow as opposed to capital gains. So it really is, and they hit you hard with that. You know, a lot of people that have been, particularly when the market crash came, that was the time for us to get in. So timing-wise, because the numbers made sense from a return point of view. If we go back to 2007, 8, 9, money even, you know, at the early stages of the crash was still pretty much available, particularly in the buy-to-let market. So we were still able to, we actually caught the tail end of it. I wish we'd have started, you know, 5, 6 years earlier. But the money was available and you were able to refinance some of the properties. There was distressed properties coming on the market under value. We were able to quickly refinance them, get the, you know, refinance the equity, use that for the next property. And we just done it, you know, that's how we done it in the early days. Then what happened is that came to a grinding halt, you know, with a crash. So what we had to go, and everyone you were talking to was, well, there's no money, the finances is a problem. So we knew that. You know, it's a way to go and solve that problem in terms of the equity. The banks would still lend on good, solid assets. You know, loan to value is less, higher margin on the interest rates. But you needed to come up with some of the equity. So we went and found private investors that would come in and work with us on that equity gap.
Okay, so you had access to reasonable bank funding, but you had to plug the gap with other investors' funds.
And we've done that through family offices. We've done that through our network that we built up through the Rich Dad network over in the States. So there's money there. So rather than sitting doing nothing, just waiting, we just went and we had to work at that because we were, not say relatively new, but we were still building our portfolio, and so we had to work at that. But yeah, that's what we've done.
So Graeme, you bring these private investors in who become equity holding partners in the company. How do they get rewarded? And presumably they're looking for some kind of exit.
Yeah, well, so we have many different entities set up over the years. So we started off smaller, and of course we're at a higher level now, far larger level, and more complex structure, different type structures now. So they vary. Some people just have put their money in and just want a return on their capital, and they really don't care what we do with the money, but they just know that it's asset backed. Others are shareholders in the business, and we have a clear exit strategy for them, which would be a share, so they're shareholders in the business, and if we refinance at the end in say 5 years' time, they'll get their original capital back and retain their shareholding in the business, or we sell the business and that's the exit. So there's various exits, dependent on what the structure is, dependent on what the project is.
And I guess as your track record has grown over the years, it's easier to attract in new investors.
Yes, it has been, and I think the difficult was really at the beginning, trying to get some of the smaller money. Now there's so much money going, so much money available looking for a home. That's not our challenge now. The challenge is in the deals and making sure that they fit our very strict criteria as yield investors, and they've got to work for us. So that's our challenge.
Okay, great. Well, what I want to talk about after the break is how you're now looking to take this on to a whole new level. So for now, Graeme Carling, thank you very much. Welcome back to Money and Me with my guest, Graeme Carling. Before the break, we learned about how he'd gone all the way from being an apprentice joiner to being a landlord of 100 plus properties, thanks to his discovery of Robert Kiyosaki. Now, Graeme, I think it's fair to say now that you've got to a significant stage. Probably you're already a bigger landlord than 95% of people out there, but you've taken this decision that you want to take it on to a whole new level. Tell me about the thinking behind that.
Well, the thinking behind that really is driven by what the government are looking to happen in the housing market, or particularly the rental market. This has been going on, large landlords throughout Europe and the US have been going on for a while now. The UK is a very fragmented market. The new rules, regulations, taxation is coming in and effectively forcing you to either scale up or get out. I mean, it's really that simple. So we took the view that it is difficult it's more difficult now than it was 10 years ago to have a business in this sector unless you have real scale. So we're being driven that way. I think it's the right thing to do. I think for tenants, it's the right thing to do. For landlords, it professionalises the sector. Like I said, it's been a bit of a cottage industry for forever, and that's being forced through and changing now, and we want to embrace that and be a serious player in that market.
Okay, yeah. I mean, obviously, I think at the moment we have something like 2 million private landlords in the country, and for the last 5 years, there's been, I think, something like 25 pieces of what I would call anti-landlord legislation that have made it harder and harder. Partly, clearly, people are now getting out because things that were profitable are no longer profitable. But also, I think now you need scale in order to make money, don't you?
Yes.
So, are you saying that even now, when you own hundreds of properties, even that scale is not enough? You've got to go even bigger than that?
Definitely. I think the intention is to reduce the number of private landlords for a start. So we see that, but actually whether it's intended or unintended consequences is it's actually squeezing the middle bracket landlords like us even tougher. So it's even more difficult at this level than 1 or 2 level. So you really need to scale up to make the whole business work. There's 2 parts of it. One, the government are driving it, and they are looking for more professional, larger type organisation that will drive improvements in professionalism in the sector.
Right.
That's one. The other side of it is that's where the money is as well. The money flowing in, the investment coming in, are looking for scale in the sector, and so it really is that's where the money's flowing, and that's what the government are wanting. That's where we're going to head.
So that's the opportunity.
Yes,
that you're
that's
going
the opportunity.
after.
Yeah.
But I think what you were saying to me off camera was that the amount you're making per property per month has gone down significantly in recent years.
Yep.
And I guess when you get to the scale you're already at, you need just things like the maintenance side of things, the management and the oversight of all of the tenancies. So you've got structures to deal with that, but the costs have just been going up and up for you.
Yes. Yeah.
So what now? You specialise in Scotland and north of England, which are kind of lower capital appreciation but decent rental yield areas.
Yeah.
So just talk us through the sort of economics of a typical property in the portfolio.
Well, we look at a minimum double-digit gross yield as a starting point. So we're looking at steady, mainly secondary type cities. So where we live in Dundee, for example, there's high demand. It's good occupancy levels for rental properties at a reasonable mid-market level. So the numbers just make sense, and actually we're in terms of gross yields, we're able to achieve them. So that's sort of our sweet spot in our target area. In terms of capital growth, if we get 3, 4, 5%, 5% would be great. But if we're sitting anything between 3 and 5, that's fine. That's fine as well. So we're not gonna. It's not London. It's not here where we're. You're in it for that market. But it's good at the moment when we're sitting with negative interest rates. So I read last week there's a Danish bank offering 0.1 below base is what they're doing for a mortgage. They're paying you to borrow money.
Right.
So it's costing you money to keep your money in the bank. So there's so much capital out there looking for a return, and that's the market that we're in. We're in the market we offer, and the type that's asset-backed, sensible, steady, stable investments.
Okay, so people like, I guess, family offices would be attracted to that to get the yield. So you're going out talking to people who would come in with a 7-figure, 8-figure type investment?
Yeah, I mean, you're looking at, I think I said to you earlier, it's actually easier to borrow 50 million than it is to borrow 500,000 even. It's
Yeah.
just that's the scale, because there is so much capital out there looking for sensible asset-backed investments.
So I guess that's nice, but on the other hand, it gives you the headache that you've got to find portfolios you can go out and buy.
Yeah.
So
Yeah.
I mean, how easy is that proving at the
Well,
moment?
it's never easy, but in terms of, over the last 12 months, we've probably been offered 1,500 properties in this sort of area, and we haven't even really been, really pushing that, certainly in the last few months. So, but they're there. So the larger landlords, or mid-sized landlords, I call them mid-sized landlords because they're normally smaller than us. But when you're speaking to other people, they say, well, they're large landlords. But mid-sized landlords, they're just getting squeezed in the regulation. So they're attracted to offload. Very difficult for them to go and sell them on an individual basis and maybe get, so they're looking for an exit, and that's where we see opportunity.
So you are effectively their kind of escape route.
Yeah.
So they are actually open to that conversation.
Yes. They're too small for big funds or a pension fund to buy, but they're certainly they're our target range for what we're trying to do. We're looking at consolidate their portfolios.
So you've set yourself a big target, I think,
Yes.
of 5,000 units. How long do you see it taking you to build up to that?
I reckon it'll take us 5 years. I reckon, maybe quicker, but I think as long as we do it steady and the numbers make sense, a lot of the stuff we get, they just don't fit our model. So it's just we move on, and we won't try and make it work if it doesn't work. We've got pretty strict criteria on what we're looking at.
And one of the kind of opportunistic acquisitions I know you've made recently was a construction company that had gone into administration.
Yes.
And you're going to use that to help all the maintenance and development of your own portfolio. But I'm intrigued by one of the things you said, having spent, I think, something like 3 or 4 months now running the business. It's taught you some lessons about how the construction industry works, and you can see why they keep getting into such problems.
Yes. Yeah, I think first of all, as a developer and a property owner and buyer, it's important that you have some good construction companies. And we've done developments where the contractors gone bust on us, and has been a big headache. So nobody really wants, as a developer, you really don't want the contractor going bust. So now, at the other side of the fence, the company we bought, 2 years before we bought it, was turning over 60 million. On the face of it, looked good, balance sheet. From the outside, looked a real solid business. But the reality it was the margins they were going in at were ridiculously low. The slightest thing that could happen, that could go wrong, which there was nothing factored into it. So what we've seen is that there's been a race to the bottom almost in terms of margin. Every one of them, what you've seen is that they've been so focused on revenue and top line, nobody's actually looking at the bottom line to say, well, first of all, are we making a profit, and are we getting the cash in? Is the money coming in? So, and when we were doing the rounds, when we first bought the business, speaking to I'm talking dozens of other companies, all everybody was talking about was revenue. All everybody was talking, and since then, the amount of construction companies that have gone bust, the Shaler Group, just recently in the Midlands, big businesses, 80 up to 100 million pounds worth of turnover. But there was no real, in terms of cash and profit, there was no focus on that. And all anybody ever talks about is how much money they're turning over. I'm turning over this year. And there's a double-edged sword to that, because some of the contracts that, when they're trying to win contracts, are revenue based. So you won't win a contract unless you have higher revenue. So it's a bit of a catch-22 situation. So you're chasing revenue that you might be losing money on, just to get a contract next year, maybe from a local authority or the government, for an example.
It's never a sustainable model, is it, to
No,
go for
no.
revenue without the profit being there in the first place. So, on a slightly different note, it's interesting to see that you sort of started giving back a bit recently. You got involved in a homeless charity. I think you've made some of your properties available to homeless people.
Yeah, well, we've been giving back or doing charitable work in various schemes and initiatives for a number of years now. The one last year, which was one where there was a sleep in the park event, which was in Scotland. They've now taken it worldwide this year, actually. So I think they'll be doing ones here in London and all the major capital cities throughout the world. So it's a great initiative. It's run by a great charity, and we were fully supportive of them. And yeah, we made some of our properties available to homeless people that couldn't find, basically there's a shortage of accommodation, and we made them available. So the uptake actually was less than we hoped, but it was still, the properties were available for them, and we were delighted to get involved in it.
That's usually the thing where the system breaks down, isn't it? If you can't give an address, it's very hard to start getting jobs or benefits or anything else. So that's the missing kind of component. Okay, so obviously you've come a long way from where you started. As you kind of look ahead to you, if we were having this conversation in 5 to 10 years' time, where would you like things to be at that point?
I think we set ourselves some high targets, and so we should. The opportunity is there for that. We need to deliver on it. I think the market is right for us. I think the funding side of it, the opportunity in terms of the deals. So I'd like to think that we've been able to achieve what we're setting out. Like I say, it's a tall order, but I think we've got a great team of people and advisors that work with us now. So I'd like to think back, and say, well, hold on, actually we should have set our targets even higher than where we are now.
So finally, you've got your own children. You're in a very different financial position to when you were growing up.
Yep.
What are you teaching them about money, finance, and business and investing?
Yeah, well, funnily enough, our kids have been playing since the age of 5. What's the rich dad, poor dad cash flow game. So we have that. It's a cash flow Wednesday. Normally we do that, but we make them very aware of money and how it works. We talk about it. It was a taboo subject when I was small. So no, it's very much part of our discussions. And my wife and I, we work a lot. And so they're hearing it, they're meeting people, they're traveling different places. So the environment they're growing up in is different to ours. And we make sure, if they're needing something, how are they going to earn the money first is going to be able to pay for it, either through cash flow or rather than working for it. But the default position is they always work for it. They don't like that.
Well, that's a great place on which to end. Graeme Carling, thanks very much for joining us.
Thank you.
Join us again next time for another financial life story. Thanks for watching.